Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 1 of my multi-part video series called Financial and Retirement Planning Calculator Full Buildout. In this video series, we're going to walk step by step through the buildout of a financial and retirement planning calculator that will be based on the following roadmap. So starting right here with our pre-retirement calculations, the first thing we're going to do in step 1 is calculate our current net worth as of today. If we want to know what our net worth is going to be at the time of retirement or at the time when we ultimately pass and have to pass along our residual value to our posterity, we have to start somewhere. And that somewhere is going to be our current net worth as of today. Then in step number 2, we're going to calculate our after-tax cash flow for the current year. We're then going to go to step 3, where we're going to allocate our after-tax cash flow for the current year to 2 possible places. The first one would be to current year expenses, to pay our bills, to satisfy our budget, and so on. And then the second place is going to be to our net worth. Anything that's left over after we cover all of our current expenses can be allocated to increase our net worth in our pre-retirement years. Then in step number 4, we're going to calculate our net worth at the end of the current year, 12/31 of whatever year you start working with the calculator, whether that's 2024, 2025, 2026, whatever. The reason why we're not going to just start right here is because most likely the case will be that you're not going to start using the calculator on the last day of the year. You will more likely start using it at some random day throughout the year, so we have to start with what we have available to work with, and then we have to build out the rest of it to arrive at what our net worth will be at the end of any particular year. Then in step number 5, we're going to define a retirement year, and we don't want that to be just a static year. We want it to be dynamic. In other words, we want the ability to be able to toggle between different potential retirement years for purposes of scenario testing, like what will our net worth be if we retire at this age, or we retire at that age, or our spouse retires at whatever age. We need to be able to do scenario planning with dynamic inputs as part of this calculator. However, just for purposes of getting started, we will define some retirement year to start working with, and then we'll be able to adjust it after that. Then in step number 6 over here, which I've broken out between 6A, 6B, and 6C, we're going to calculate our after-tax cash flow for the current year. And when I say current year right here, I mean we're going to be projecting our income and net worth for all future years between now, in other words, between this ending date right here, and whatever retirement year we have previously defined. So for example, if this is 12/31/2024 right here when we're starting our calculator, this would be the after-tax cash flow for 2025. Then we would take that after-tax cash flow for 2025 and we would allocate it to expenses for 2025. And ultimately what is left over after we allocate to expenses will go into our net worth calculation for 2025. And then ultimately over here in step 6C, we will calculate our net worth at the year end 2025, or whatever year we are working on. In fact, we will repeat this process right here in step 6 over and over and over again, as I mentioned, for every year between here and whatever retirement year we have defined over here. So to summarize the pre-retirement calculations, ultimately what we want to do is start with our net worth today, and then through multiple iterations of calculating our after-tax cash flow and allocating it to our net worth over the time between today and our retirement year, we ultimately want to end up figuring out over here in step 7 what our net worth is going to be at the time of retirement. And as I mentioned, we want to be able to do that in a dynamic way so we can test out different retirement ages and years and see what the differences would be in our net worth. Now, as we are thinking about these after-tax cash flow calculation and allocation decisions to our net worth, let's go over some items that we want to incorporate into our calculator for purposes of these projections. We want to be able to consider market rates of return. We want to be able to consider an emergency fund, income taxes, interest and dividends that will be going into our portfolios, the effects of inflation, allocation of funds to pre-tax accounts such as 401ks or traditional IRAs, allocation of funds to post-tax accounts such as Roth designated accounts. We want to consider non-taxable income such as muni bond income or gift income. We want to look at loan amortization, for example, mortgage loans and vehicle loans. We want to consider disposal or liquidation costs such as the cost to liquidate real property. We want to consider the impacts of property appreciation or depreciation over time. And we also want to consider special purpose account allocations such as health savings accounts or 529 education plans. Then when we get down here to our post-retirement calculations, we're going to start in step 8 by defining a goal year as well as a residual value. Now, a goal year is going to be the year that you are ultimately going to pass. And a residual value is the amount of cushion that you want to have beyond your goal year after you do the rest of your financial planning. And a residual value can also be considered what you want to pass along to your posterity at the end of your life. Now, just as before with the retirement year, we want both the goal year as well as the residual value goal to be able to be dynamic in nature. In other words, we want to be able to test different scenarios, different ages, different amounts of residual value as part of our overall financial and retirement planning. Now, after step 8, we're going to go over here and we're going to continue to project income and net worth for all future years between the retirement year and the goal year. So in step 9A, we're going to calculate our after-tax cash flow. Step 9B, we're going to allocate our after-tax cash flow to current year expenses as well as net worth. And step 9C, we're going to calculate our net worth at year end for each of the years between the retirement year and the goal year. Now, changes that we want to incorporate into our calculator for purposes of the post-retirement projections are going to be as follows. The first one, the general expectation, is a change from net cash inflow in pre-retirement years to net cash outflow in post-retirement years. So for example, generally speaking, in this equivalent step in the pre-retirement years, I would expect net worth to be increasing as we allocate our after-tax cash flow. However, right here in step 9B in the post-retirement calculations, it's a very common situation to see net worth decreasing because people are generally using up funds or assets that have been accumulated over the course of their life during their retirement years. So our calculator needs to be able to incorporate this kind of general change in expectation. Other changes we want to consider can include changes in sources of income, for example, going from W-2 wages to Social Security and pensions, changes in the makeup of expenses, for example, going from home ownership expenses to retirement living expenses, use of funds coming out of retirement accounts, like I mentioned a few moments ago, as well as changes in investment return, for example, moving from more aggressive to more conservative portfolio weightings. In addition to that, we want to set up what I'm going to call a command center. And that is going to be the part of our financial and retirement planning calculator where we can do scenario testing as well as view the results of everything that we have set up. And within the command center, we're going to want to see toggles, we're going to want to see switches, we're going to want to have the ability to test varying fact patterns. Basically, we want a centralized location where we can modify and view our financial position and projections. With respect to viewing the results, we want to see asset summaries, we want to see debt summaries, we want to see net worth summaries. We want to be able to test if our results meet our expectations. But in addition to having our summaries within the command center, we also want the ability to dig down and do detailed analysis of our financial position and projections. And we want the ability to view the detail on a year-by-year basis, both for our annual after-tax cash flow projections, as well as our annual net worth calculations. And we want to be able to do that for both our pre-retirement planning as well as our post-retirement planning. So we have a tall order laid out in front of us. We have a lot of things to put together, a lot of items that need to be incorporated into this scenario planning. So with that said, let's jump in building our full financial and retirement planning calculator. All right, so we're going to start with step 1 as we defined it in the roadmap, which is to determine what our net worth is right now. And I'm going to call this tab the Net Worth Projector. I'm going to say that this one is for pre-retirement purposes. There are two possibilities that I am envisioning. Either we will expand this projector to incorporate both pre-retirement and post-retirement planning, or we will build this one out in its entirety and then make a copy of it and use the copy in probably a slightly modified way for post-retirement planning. If you recall, the general assumption for the pre-retirement net worth calculation is that net worth should generally be increasing over the course of the pre-retirement years, and then we have to build in functionality such that net worth can generally be decreasing over the post-retirement years as accounts are liquidated or otherwise used up for retirement living. So we'll see how that plays out after we build out the first one for pre-retirement. Now, what I've done here in the first column is I've tried to set up several sections to work with, starting with assets and specifically starting with financial assets or investment accounts. And I've broken those up again into several sections. So we have our regular investment accounts. These are non-tax advantaged accounts. So we'll start with our cash accounts. We have our checking accounts, savings accounts, money markets, CDs, and so forth. Then we're going to have our portfolio accounts, our digital assets. We're going to have an emergency fund. And I'm going to throw in a couple placeholders here just in case we come up with some other account types that we need to put in here. As we build this out, I'm going to leave room for other things that we may not think of on the first pass. After that, we're going to move into our investment accounts, which are pre-tax or tax-deferred. Those would be like our 401k plans, our traditional IRAs. We have SEP and simple IRAs. These are business IRAs. We have our 403b accounts, our 457b accounts, our thrift savings plans. These are for various types of public school employees, nonprofits, government employees, U.S. service members. Thank you for your service, by the way. We could have tax-deferred annuities. We could have employee stock ownership plans that are pre-tax, other types of pre-tax deferred comp, and then again, some more placeholders for things that we didn't think of initially. Continuing to move down here, we're going to have some special purpose accounts, which are tax-deferred, for example, a health savings account or a flexible spending account. And then we'll move into our after-tax investment accounts, which are tax advantaged. However, they are post-tax, not pre-tax. The most common examples of that will be our Roth 401k plans, our Roth IRAs, other types of Roth designated accounts, employee stock purchase plans that are on a post-tax basis, 529 education plans, and then other post-tax type of accounts. Moving down into section 2, we have to list out all of our other assets that are not financial assets. For example, real and personal property would be the most common examples. So we have our real property assets, and I wrote not cash flow generating right here, meaning these are not rental properties, these are not business assets, these are our personal assets. So we have primary residence, secondary residence, vacation home, land that's held for investment purposes, but it's not cash flow generating. After that, we have our vehicles. Again, these are not business vehicles. We have our automobiles, we have recreational vehicles, boats, other things that we may not have thought of but have enough value to be included in our net worth calculation. Moving down, we're going to list out various kinds of personal property property that may have significant value or sufficient value to be included here. Precious metals like physical precious metals, jewelry, art and collectibles, commodities, intellectual property. And then I put a bunch of placeholders here for other things. I can't possibly think of everything that various people may have, so there's enough room here to add in some other items. And then down here we're going to have a catch-all bucket for anything that doesn't appropriately fit into any of these other categories above, like maybe cash surrender value of life insurance or something like that. And then finally we'll have our total assets, which is going to be the sum of everything that we have listed so far, basically all the way up to right here once we start typing in numbers. Okay, then down here in section 3, we're going to have our debts and other amounts that are owed. Most common example would be like debts on real property, mortgage loans, home equity lines of credit, other debt related to real property. We could have various kinds of vehicle loans right here. We could have personal loans, student loans, other types of term loans. Now, I did put a place here for credit card debt or other kinds of revolving debt, and I would envision that this would only be used if you had an accumulating balance on revolving debt. And obviously, having accumulating debt in this category right here certainly can be very detrimental to your financial future. So we're going to talk in more detail about this specific item later on in the program. But for now, I've just put some placeholder rows here in case we need them. And then finally, down here is going to be a catch-all bucket for other kinds of debt that people may have outstanding, like retirement loans from borrowing from your own IRAs, for example, past due tax debt, rent in arrears, unpaid medical bills, unpaid other, and then just some other placeholders for anything that doesn't appropriately fit into one of these categories. So then right here we'll have our total debts and other amounts owed, and then our net worth before taxes down here is going to be the sum of all of our assets right here minus the sum of all of our liabilities right here. Now, the reason I said that this is before taxes is because, as you recall, if we go back up to the financial accounts, right here as set up, all of these are going to be on a pre-tax basis in this list so far. So when we calculate our net worth on that first pass, we have to recall that all of these are going to be taxed when the money comes out. And we're going to deal with the taxation of those when we get to our annual after-tax cash flow projector, which is going to be one of the next things that we build out. But for the moment, let's just keep this description right here, just so that we can remember that we have some accounts in the list above that are on a pre-tax basis. Now, going back up to the top of the list here, one of the easiest ways perhaps to set this up is, instead of saying we're going to determine our net worth today, it might actually be easier for a lot of people to determine what it was, or at least a close estimate of what it was as of December 31st of whatever the prior year is. And the reason that that may be simpler is because you may have a lot of brokerage statements and bank statements and other documentation that will show what the values are at year end. Whereas if you just try to type in numbers as of today, quote unquote, those values may not be as easily accessible or as readily available. In addition to that, determining what the income and market return is on all of these accounts from the end of one year to the end of another may actually be a lot easier than trying to determine what is the income starting today, some random day, through the end of the year. So with that in mind, what we're going to do is we're going to lay out our ending values as of the end of the prior year. We're going to project interest and dividends and other kinds of income that will go into our portfolios and cash accounts. We're going to project a market return independent of the income component. This market return can represent a combination of realized as well as unrealized gain. So we're going to put a column in here for the realized portion of the gain, capital gain, that's going to be taxable in the current year. And again, that may only represent a portion of the total gain that's right there. So we'll figure out how to work with these two components together. Then I'm going to put in a column for fees and disposal costs relating to any kind of assets. This could be a whole variety of things. For example, account fees in your brokerage accounts. It could be real estate commissions on selling real property. It could be fees associated with closing out a CD early, for example, before the term is up. Anything that would decrease your net worth but is not necessarily a tax deductible item. Those are the kinds of things that we're ultimately going to put into this column when we get there. Then we need a column for the current year free cash flow that is allocated to our net worth. And the values that we're going to put in here are going to come from our annual after-tax cash flow projector as soon as we build that out. Again, this is after you earn all of your income and you pay all of your expenses. Where does the rest of the money go? It has to go somewhere. It can't go nowhere. It's going to have to go somewhere into one of these various accounts or assets or against liabilities. Anywhere in this column it could go, but it has to go somewhere. So that's what this column right here is going to represent. And then finally, when we sum up all these things, we're going to get our market value of all of these accounts and assets and liabilities at the end of the current year. So let's start dropping some numbers in here and figuring out our net worth. All right, so I have dropped some numbers in here. I have also added a few new columns. So let's go through everything one by one and see what we got. So the first new column right here is going to be a lookup reference. If you follow my videos, you know that I like to use a lot of VLOOKUP. So in order to use VLOOKUP, we need to have something for the formula to actually look for. So I created a column that just has codes in it, and those codes can be anything that you make up. The reason I want to use codes is because we can be consistent with these all throughout this tab as well as other tabs that we're going to create. And by using codes for reference purposes, it allows you to be able to change any of these descriptions right here to something that is useful to your facts and circumstances. If we try to use these account names for lookup purposes and people are changing them to something that is more useful to their situation, that won't be particularly helpful for our formulas. So we're going to use these codes. For now, let's just understand that that's what these are. We'll deal with linking them up via formula later on. Okay, the next new column is going to be our income that is going to go into our portfolio accounts. So I wrote interest and dividends, capital gain distributions, rate of return. So this column represents income going into our portfolio and cash accounts independent of any market return, which is going to be over here. Now for the moment, I want you to just think about interest, dividends, capital gains as all just money going into the portfolio. Let's not concern ourselves with qualified versus non-qualified dividends, with long-term versus short-term capital gains. All of those terms that I just used are a tax treatment. It has nothing to do with the amount of actual cash. $10,000 of qualified dividends and $10,000 of non-qualified dividends is still $10,000 of cash. Same thing with $10,000 of short-term or $10,000 of long-term capital gain. It's still all just $10,000 of cash. We will deal with figuring out the tax treatment on all of those various components later on in the video series when we build out our effective tax rate model. So the percentages down here are going to represent the income return on any of these portfolio or cash accounts. Now, once we build out the command center, we will decide which ones of these or how many of them should actually be linked to the command center so they can all be changed from the same location. We don't want to turn this entire thing into the command center. That would kind of defeat the purpose of having a command center in the first place. So as we work through this, we will find a balance between putting every single possible thing that can be toggled into the command center versus putting in some high-level summaries and maybe linking up multiple of these to one place within the command center. We'll get to that when we build out that part of the calculator. Now, the next new column is going to be a market rate of return. That is not going to apply to any of our cash accounts because there is no market return on those, so I've grayed those out. But for any of our portfolio accounts or any other kinds of accounts where there could be a market return component, we want to have a toggle where we can adjust the market rate of return, and that's what this is going to represent. represent. Okay, for the market value, I've just put in 2023 as an example, so we're going to figure out the net worth at 12/31/2023. So in this example, let's go through the numbers that I've thrown in here. I have $10,000 in checking 1, $20,000 in checking 2, $5,000 in savings 1. I have $1,000 in a money market, $20,000 in a CD. We have $300,000 in a regular brokerage account with no tax advantage attached to it. We have $10,000 in an emergency fund, $400,000 in a 401k plan, $40,000 in a traditional IRA. If I keep scrolling down, we have $10,000 in a health savings account. We have $50,000 in a Roth 401k. We have $10,000 in a second Roth 401k. And we have $25,000 in a 529 education plan. Then if I keep going down to section 2, assets, real and personal property, we have a $650,000 primary residence. We have a $50,000 investment in land. We have 2 automobiles, one with a $60,000 value, one with a $30,000 value. We have some personal property, physical precious metals worth $10,000. We have jewelry worth $5,000, art and collectibles worth $30,000, for total assets of $1,736,000. Now, if we continue down into section 3, debts and other amounts owed, we have $538,000 and change in mortgage loan number 1 on the primary residence. We have 2 vehicle loans, one at about $38,000, one at about $39,000. And then we have a personal loan for about $22,000. We have a student loan outstanding, and we also have another term loan that I've put in the placeholder just so that we can work on different kinds of amortization schedules related to term loans later on in the video program. So the total of debts and other amounts owed down here is just under $700,000, resulting in a net worth before taxes of about $1,048,000. And as you recall, this is a pre-tax net worth, considering the fact that if we go back up, this $400,000 right here in the 401k plan, as well as this $40,000 right here in the traditional IRA, are both pre-tax. And as I alluded to earlier, we will get to dealing with the tax effects of distributions of these accounts later on in the video series when we build out the annual after-tax cash flow projector. So if we scroll back down here, this couple or individual, we will set up the calculator to be able to handle both one person as well as 2. They have a net worth of about $1 million less any tax effect on that $440,000 that's in those pre-tax accounts. Okay, now that we have the net worth established based on the market values at 12/31/2023 in this example, the next step is to calculate the interest and dividend and capital gain distribution income related to each of these different kinds of accounts. And that calculation is going to be whatever rate of return we specify for that particular account multiplied by the balance at the end of last year or the beginning of this year. So that is going to apply to everything in this column right here that we have not grayed out. In some cases, we will gray out the cells because if we get down here like into physical assets, for example, real property, vehicles, and so forth, there is no interest or dividend type of return on these kinds of assets. And if I continue scrolling down into the debts and other amounts owed section, we're not going to have any return related to interest or dividends here either. The one caveat that I will throw into that is with respect to revolving debt right here, or with respect to any of this miscellaneous debt, if the principal amount is increasing, then we will have to incorporate some type of calculation down here in order to allow the balance of this debt to increase within the calculator. We will come back to that specific nuance later on in the video series when we deal specifically with these items. With respect to interest that is being incurred on term debt, that is all handled within the amortization schedules, which we will set up, and the interest expense will be a subtraction in our after-tax cash flow calculation. So the only thing that I'm going to expect to appear on the net worth calculator related to these items is going to be the decrease in the principal balance, which is over here, and we will talk about that in just a little bit. All right, next up is going to be the market return, and the calculation for that is very similar to this one. It's simply going to be whatever rate we specify for market return by account multiplied by the opening balance for the year. As I mentioned earlier, for accounts that do not have a market return component, I've just grayed those out. If we go down here to the real and personal property section, some assets may have a depreciating value associated with them, particularly vehicles would be the first one that comes to mind. Now, in some cases, if you have some type of collector vehicle or something that might actually appreciate in value, that item could be put down here in this section, or you could just change one of these rates to a positive number so that the value grows over time. However, generally speaking, with respect to automobiles, I have a negative rate in here so that the value of the asset will decrease within your net worth calculator until such time as the value reaches zero or you sell the asset. Now, I want to be clear on this concept right here. This is not tax depreciation. Automobiles are not depreciable for tax purposes. In other words, you cannot deduct on your tax return depreciation expense associated with a personal automobile. The point of this rate, just like the point of all of these rates in this column right here, is to help figure out what your net worth is going to be. And while you should include automobiles most likely within your net worth calculation, the actual market value of the vehicle is probably going to depreciate somewhat rapidly. And so in an effort not to overstate our net worth, we want to make sure to have a rate in here which is reasonable and allow the market value of these types of assets to decrease with each passing year. All right, now going back to the top here, we have our realized or taxable market return, i.e. capital gain. And I want to distinguish this capital gain right here from capital gain distributions, which we have over here in this column. So as you know, a capital gain distribution is when the underlying fund, like a mutual fund, has a capital gain and you get a distribution related to it. Now, inherent in the assumption to include capital gain distributions in this column, in other words, in this rate of return, would be the notion that this is increasing your net worth, that you are actually getting cash in the form of a distribution. Now, I know there's going to be people watching this video who will argue, if you get interest or dividends or capital gain distributions from an underlying investment, in theory, the market value of the investment should decrease by the amount that they distributed to the shareholders. And thus, the impact on your net worth would be a wash if you receive a dividend and the value of the investment goes down by an equivalent amount, then it's a wash. Now, whether or not that holds true in practice is a discussion that we could have another time. For purposes of building out the calculator, it is inherent in this section right here that your net worth is increasing by the value of these types of income items. In this column over here, this is going to represent capital gain that incurs from you having transactions within your own portfolio, not from distributions from an underlying investment. And I'm going to take the position that this is strictly a tax recognition event and that this type of capital gain does not impact your net worth. We're going to do an example in just a second. But the reason I bring that up is because this $10,000 of capital gain recognition, it could be from market gain in the current year, it could be from market gain in prior years, it could be a combination of both. So it may or may not have any direct relationship to the market gain that's being realized for the current year. In addition to that, when I sum this row across to figure out what our market value at the end of the year is going to be, I have specifically we excluded this column. In other words, when I click on this, the market value is being calculated based on the beginning value plus the interest and dividends and capital gain distributions plus market return plus these items over here, which we're going to get to shortly, but not including the capital gain, which we have specified in this column. This item will be taken to the cash flow projector, which we are going to build out in a future video, and it will be taxed. But again, I'm taking the position that whether it's taxed or not, this item is not additional cash. This does not impact our net worth. Let's do a simple example. All right, so we buy 100 shares of stock for $30,000. At the end of the year, the 100 shares is worth $40,000. Assume the position has not been sold. What is your net worth with respect to just this item? And the answer is, at that moment that you are measuring your net worth at that last day of the year, your net worth is $40,000 with respect to this item. Alternatively, you buy the same 100 shares for $30,000. At the end of the year, the 100 shares is worth $40,000. Assume the position has been sold. What is your net worth with respect to just this item? And the answer is, ignoring taxes, it's still $40,000. There's no difference in the two scenarios except for the tax effect. Okay, so ignoring the tax effect of the transaction, the impact of the $10,000 gain on your net worth is the same regardless of whether the gain is unrealized or realized. So if we go back over here, just to demonstrate that even more clearly, let's just pretend for a minute. I'm going to just type a number in here. Let's just pretend that the total market return was 10,000 and it all represents a position that was sold. So all of this 10,000 is the same as this 10,000 in this example. Well, then what's our net worth with respect to this position right here? It's going to be the 300 plus 9 plus 10 is the 319. The tax effect of this item is going to be handled on the cash flow projector. And then ultimately the free cash flow after all expenses and taxes and whatever else is going to be brought back into the net worth calculation over here in the column we're about to go over in a minute. So if the impact of this tax recognition event, in other words, the tax cost, is handled over here in the cash flow projector and ultimately arrives back in the net worth calculation via this column right here, which we're about to cover, then the only items in these four columns from here to here that impact our net worth are going to be the first three. This one, and this one will have no impact. So let's put this one on the back burner for the moment until we get the cash flow projector built out, and then we will trace this all the way from here through the cash flow projection, through the capital gain getting taxed, and then having the remaining free cash flow after tax come back here into the net worth calculation. Okay, the next column here is the cost of fees and disposals. This is going to be kind of a catch-all bucket for expenses that reduce our net worth, but they don't run through our cash flow analysis, and they also have no impact from a tax perspective. So what are some good examples of that? Well, if we go back to this row right here with the portfolio account, actually, let me just change this formula back here before we forget. So if we start right here, if this is the balance at the end of last year and this is our return from two different sources, what is something that we could potentially see over here? Well, it could be the fees that you pay to your financial advisor, for example. Let's just say you pay them $8,000 for the year, and this $8,000 doesn't run through our free cash flow analysis because in most cases it's taken directly out of the brokerage account. So it does decrease our net worth, but it's not an item that we are budgeting for as far as our cash flow analysis over here. It's just an expense that disappears, quote unquote, directly out of the brokerage account. And so that's an example of something that could go here that would reduce our net worth as of the end of the year, but doesn't run through this column. Okay, the next next column is going to be our free cash flow after all of our annual expenses, after taxes, whatever is left over that gets allocated to our net worth. That is what's going to go in this column right here. Once we build out the cash flow projector, all of the rows within this column will be linked somewhere so we can make this an automated calculation. However, for the moment, I'm just going to type in some numbers just so we can see the concept. So let's walk through what this individual or couple has done. And let's start right here. So here's a $10,000 pre-tax allocation to a 401k plan. Here is a $20,000 allocation to a 401k plan. Here is a $7,000 allocation to a traditional IRA. Going down the list here, we have a $3,000 contribution to an HSA. We have a $5,000 contribution to a Roth IRA. Now that I'm looking at this, I realize this is both for spouse one right here, and this is also for spouse one. You are limited to approximately $7,000 in total IRA contributions per year per person. That amount is indexed for inflation, but this would obviously be too much. So I'm going to go ahead and delete that, and let's just move that down to spouse number 2. Like that. Now going down the list here in section 2, real and personal property, we certainly could have allocations of current year free cash flow to various assets. For example, if we used current year funds to purchase assets. In this case, I haven't actually put any numbers in here, but we certainly could and will have a place within the cash flow projector to accomplish that. Continuing on to section 3, debts and other amounts owed. Here's $12,000 of principal going against mortgage 1, $6,000 and $5,000 of cash going against the principal on vehicle loan 1 and 2, and then several $1,000s going against the principal of these other various loans. And so if we look at the math here, we have $48,000 going towards assets. In this case, it was all contributions to various financial assets. We also have $30,000 going against liabilities down here. So if assets are increasing by $48,000 and liabilities are decreasing by $30,000, then the total increase to our net worth is $78,000 in this example. And as we mentioned before, that is still pre-tax to some extent, in particular the amounts that go to the 401k and traditional IRA types of accounts. And then finally, if I go back up here to the top, after all of these various allocations, after all of our other expenses, after taxes, after everything else, whatever is left, we will be able to allocate that to somewhere within our net worth. And I have chosen just to put it here in checking 1, $3,000 is what was left in this particular example. Okay, so the next column is going to be for special purpose accounts, and I'm going to gray out the rows to which that does not apply. If we go down here to a health savings account row as an example, this is saying we had a $10,000 balance at the beginning of the year. We had $300 in interest and dividends going into that particular portfolio, $100 of market return, a $3,000 contribution, that is a pre-tax contribution to an HSA. And then this right here would say that we took a distribution of $2,000 from the HSA to arrive at a net worth value at the end of the year of $11,400. So if I double click on this one, this does include this decrease right here of $2,000 that was taken out of the HSA, presumably used for medical purposes. Now, one distinction that I want to touch on right here between the investment accounts that are tax deferred as well as the special purpose accounts that are tax deferred is as follows. Money that is contributed to these accounts right here will go in on a pre-tax or tax deferred basis. That is the same thing right here. This will go in on a pre-tax or tax deferred basis as well. However, the big difference is going to be that when distributions come out of this section right here, our 401k plans and our traditional IRAs, this money will get taxed on the way out of those accounts. However, when it comes to special purpose accounts, this money right here will not get taxed when it comes out of the account, provided it is used for the purpose for which the account is intended. So for example, an HSA is intended for healthcare or medical related expenses. Provided you take this distribution for that purpose, then this amount will escape taxation completely. It will not be taxed on the way into the account, and it will not be taxed on the way out of the account. And so for purposes of setting up the calculator, we have to account for the distinction between this kind of distribution, which is not subject to tax, and distributions that are going to happen up here that will be subject to tax. And for the moment, I have created this special purpose column to handle that, and we will review this once again in detail as soon as the cash flow projector is complete. Okay, the final new column that I have created so far is going to be this current year reallocation of assets and or debts within our net worth, and this can be a positive or negative amount. In fact, this column right here in its entirety will always need to net to zero. Now let's think about the details of that. I am going to scroll down here to the remaining part of this transaction. Let's start right here in this row. So here is a piece of land or other investment property. Let's say that the market value of that was $50,000 as of the beginning of the year. We have a small market return attached to it, and we've also said that there is $10,000 of capital gain associated with the sale of this piece of land. So inherent in these four columns right here would be the notion that the actual fair market value of the land is $50,250, and of course in the real world it's never going to be exactly the same amount that we've been projecting. But for purposes of this example, let's just say it's $50,250 is the fair market value, and we have a $10,000 capital gain associated with it, which would mean that the basis would have to be $40,250. That's what these four columns right here are stating. Here's another example of fees and disposal costs. Let's say that there was $3,000 in closing costs or real estate broker commissions or whatever associated with this transaction. And so what is the cash in hand result of this transaction? Well, it's $50,250 of fair market value or sales price, less $3,000 that was paid in commissions and other fees, which equals $47,250 cash in hand. In addition, this piece of land is now gone, so we have to take it off of our net worth calculator completely. And so that's what this column right here, current year reallocation of assets and or debts within our net worth, that's what this is for. The basic question is, where does this cash go? It has to go somewhere. It can't go nowhere. And there's only three possibilities where this cash can go. Number one, it can go to increase another asset that remains within our net worth calculation. If that's what happens, then there's no change to our net worth. It is simply a reallocation from this particular asset into another asset. Possibility number two is that the cash could go against a debt or other obligation to reduce the balance of that debt. And in that case, it would have no impact on our net worth calculation either, because it's simply moving it from an asset into the reduction of a debt or other liability. And the third possibility is that it could reduce our net worth by coming off of the net worth calculator and going against just some expense which has no net worth remaining value after the money is spent. For example, like a vacation or something. Those are the only three possibilities where money could go. It can't go nowhere, it has to go somewhere, and it has to go to one of those three places. Either it remains in our net worth as a new asset or reduction to a liability, or it leaves our net worth and goes against some kind of expense. So right now, and for purposes of this particular column, we are going to treat it as going toward other assets. So just as an example, I'm going to take $30,000 of this amount and I'm going to bring it down here, and we're going to purchase a boat. quote. Now, whether that's a smart purchase or not is completely up to you. We're just talking about the mechanics of how the mathematics is going to work within the calculator. So $30,000 of this cash goes into this asset right here. And then if I scroll back up to the top of this screen, the remaining $17,250 I'm going to put into checking 1. And so between the allocation to this cash account number 1 and this other asset number 2, the net result in this column right here is going to be 0. And for purposes of this column, it's always going to be 0. If we want to take this cash against another expense and have it come out of our net worth, we will accomplish that when we build out the cash flow projector, and that will be coming up in a future video. All right, and then the final column right here is going to be our market value at 12/31 of the current year, and that calculation, as we have talked about, is going to be the sum of all of these columns except for the capital gain column, the tax effects of which will be handled over here in the cash flow projector. So after going through all of those different columns, let's think back to our calculator roadmap and think about where we are so far in the process. So I'm back over here looking at our roadmap for the pre-retirement calculations. Now we definitely have accomplished this right here. And instead of today, meaning any random day within the year, we have accomplished step 1 by doing 12/31 of whatever the prior year is relative to the year you're currently working on. So in our example, we were working on 2024, and so step 1 was completed using 12/31/2023. In addition to that, we have used some placeholder examples to show what this part right here, step 4, would look like. And step 4 is talking about this column right here. However, we have just used placeholders for step 2. We haven't actually done the full after-tax cash flow calculation. So we haven't really completed step 2 yet, and without step 2, we can't complete step 3. So the next thing we have to do, and where the next video in this series will pick up, is right here in step 2, the after-tax cash flow calculation. So that's going to be it for this video number 1, and I will see you in video number 2.